Bring in Credit Suisse's Jonathan Golub, who joins us now, along with Ed Yardeni of Yardeni Research. Jonathan, I'll start with you. Given the collection of data that we've seen this morning, PMI that rose slightly, ISM that's the best read since November 2018, even though the employment picture still shows contraction there, what do you make of it, Jonathan?
I think this is a little bit of a shoulder shrug. We know that sequentially the economic data is going to be getting better, that this month is better than it was a month or two or three ago, but it doesn't really give us a read the way that the ISM is calculated on the overall health of the economy compared to what a fully operating economy would be. Our expectation is that for the next month or two, we'll continue to see progress, but then as the comps get a little more difficult, that it's going to soften up a little bit into the fall.
You talk about sort of the marginal improvement of some of this data on a month-by-month basis. Do you think the market is pricing in this recovery taking 1 to 2 years to be a full rebound, or do you think it's still expecting this sharp V that we've been hearing from Washington is in the wings?
No, there's not going to be a sharp V. There's a sharp V off the bottom when you have an economy that you close down. You shut the lights on it, and then you open it up, and all of a sudden, yes, you get a big bounce. But if you look at the bond market, if you look at where the 10-year bond yield is right now, it's saying that we are going to have a slower, long-term economic environment for a very long time. And mind you, when we went into this crisis in February, we had a 10-year bond yield that was under 2%. So it wasn't like the underlying expectation was that we're going to have a gangbusters economy. And I think the confusion is that when the stock market is going up, people keep saying that the market is this indication of this fantastic economy we're getting. It's really an indication that a smaller group of companies are doing incredibly well, and that the discount rate for stocks, the interest rates, are actually boosting up the value of equities. It's not that the economy is going to continue with the V like this.
To Jonathan's point on that, at what point, if ever, do stocks reflect macro weakness in the parts of the economy that equities tell you nothing about?
Well, look, I think we are seeing a restructuring our economy in response to the pandemic. Clearly, people who can work from home are working from home, and many of them may continue to do so. We're seeing deurbanization as people move to the suburbs. We got a housing boom, which has been a very big positive force for the economy. And with mortgage rates at record lows, that's been able to continue even though home prices are going up. So I think that the parts of the economy that are actually doing well and actually maybe have gotten a benefit from the pandemic, and I'm talking about the internet stocks, the cloud stocks, the housing stocks, all those areas have really been the leaders of this bull market. And so that's perfectly consistent with what we're seeing in the economy.
Mm-hmm. On inflation, the lumber, for example, gets thrown out a lot as a canary. But is it simply reflective of as you said, mobility, moving to suburbs, not indicative of some larger presence of creeping inflation, the kind that the Fed hopes to build?
Yeah, well, the inflation numbers have a whole bunch of components to them. One of the biggest one is actually rent. And we do know that rent inflation is likely to go down quite sharply here. As a matter of fact, I'm not sure that we're even measuring it correctly, because there's a lot of people who just simply haven't been able to make their rent payments. So I think for the short term here, there's some pretty powerful forces keeping a lid on inflation. And lumber is not directly in the CPI, maybe it's in the PPI, but the best cure for high commodity prices is high commodity prices. I suspect high lumber prices are going to lead to an increase in supply.